demystify if the assured return schemes, buyback schemes, and subvention schemes floated by the builders are legal. Hello, friends. Thanks for tuning in. I welcome all of you to my YouTube channel Legally Determined. This is Sanjay Arora by profession. I am an advocate in Delhi. Real estate projects are capital intensive. The builders need to arrange finances for executing a real estate project through as less expensive a medium as possible. On the other hand, investors are wary of investing in real estate projects since the quantum of investment required and risk taken are both high. The builders at this stage try to source funds from the buyers only. Interestingly, even buyers need loans for purchasing a property and many times take loans from the banks. Bank loans are easily available to buyers with a constant source of income, and developers can take advantage of this situation. Thus, through buyers, the builders can take loans from banks indirectly under smartly planned schemes, namely assured return schemes, buyback schemes, and subvention schemes. The situation is tricky, but if the arrangement works, it can be a win-win situation for both the builders and the buyers. How can the builder raise finance from the buyers? Assured return schemes. In an assured return schemes, the builder promises to pay the buyers regular interest at a rate higher than bank interest on a regular basis for upfront payment of the cost of the property in the range of 90-95% of the total cost. The buyer thus pays around 90-95% of the total cost of the property for assured returns, which may range from 10-12% of the investment. This is a cheaper debt for a builder as the debt from the finance market is available at higher rates. The buyers, usually the common people unaware about the height of risk undertaken, pay the money in hope of better returns. Such returns are at rates higher than bank fixed deposits or, for that matter, even debt funds. And since these are assured, a debt fund is a mutual fund scheme that invests in fixed income instruments such as corporate and government bonds, corporate debt securities, and money market instruments, etc., that offer capital appreciation. Debt funds are also referred to as income funds or bond funds. It's a less risky mode that equity and that suits the buyer too. These schemes are generally used for commercial projects and also for investors who want to put money into property as an investment rather than use it. The builders will enter into a memorandum of understanding MOU for the payment of the assured returns to the buyers. The returns may be provided to the buyers in the form of post-dated checks or bank guarantees. The duration of the payment of the assured returns can be up to the possession of the unit or 1 year after the possession. The buyer will pay a significant part of the cost of the unit. Once the property is completed, the builder can actually lease it out to a tenant to pay the assured returns to the buyer if the duration is for a period beyond the date of possession. The buyer then pays the remaining amount to the builder and owns the unit. The assured returns schemes are offered to the buyers at a rate per square feet which is higher than it would be if there were no assured returns. The builders sort of funds the assured returns from the buyer's own money. There is a benefit from receiving the money in advance instead of in phases or in accordance with stages of completion of the project. Buyback schemes. A buyback scheme is just another variant of the assured return scheme. In an assured returns scheme, the builder will be promising assured returns on the property without taking the ownership back, while in a buyback scheme, the builder will take back the ownership at a pre-agreed higher price compared to the one which the allottee has paid at the time of booking. However, in this method, the builder is clearly relying on the market to pick up to be able to buy at the agreed rate from the allottee and sell at a still higher rate. Further, there is a clear presumption that the project will be completed at an agreed time, which may not happen. Allottees should therefore be extremely careful before they proceed to book units in such a scheme. Subvention schemes. A subvention scheme. A subvention means support or grant of money. The subvention scheme is to encourage buyers who are looking for housing finance to buy the property and may not be able or willing to part with the interest on the loans, at least initially. In the subvention scheme, there will be three parties, namely a builder, a buyer, and a bank. The buyer will pay a certain amount of money towards the property as a down payment. The bank will finance the rest of the amount and pay it to the builder as a loan to the buyer. The unit purchased by the buyer is the security against such a loan. The builder will pay the interest on the loan to the bank as a method of assured returns to the buyer. The buyer may be required to pay the equated monthly installments EMI for the loan to the bank after possession of the property. The loan is granted to the buyer and he is ultimately responsible for any default in the payment. If the building construction and financing are properly planned, the assured returns can work for both sides. But if the cost of the project is not properly estimated, the completion of the construction gets delayed and the builder is required to pay assured returns for a longer period of time than was planned. This may lead to the builder getting into financial difficulties and might actually result in a default in the payment of the returns. Further, from the point of view of the investors, if the builder has paid the assured returns in the form of post-dated checks and these bounce, the investor does not get any returns. It is actually a significant amount of risk for the investor, since a good deal of the amount of the cost of the unit has to be paid as a down payment. It blocks a substantial amount in a risky venture. What are the implications of the law on such schemes? There is nothing in the law which outrightly makes such schemes used to finance the real estate projects are as illegal, although there are two legislations which have an effect over the working of such schemes: the Real Estate Regulation and Development Act 2016. Under the provisions of the Real Estate Regulation and Development Act 2016 (RERA), no advertisement for a project can be made without registration. Therefore, even the assured returns schemes cannot be advertised without RERA registration. This provides some recourse to the buyer if the possession is delayed. RERA provides that 70% of the amounts received from the allottees has to be locked in a bank account and be applied towards the construction cost and cost of land of the project, and further that the deployment of funds from that bank account must be in accordance with the phases of construction of the project. It would therefore seem that the builders would have only the scope of 30% of the amount left for the purpose of returning the amount to the buyers. This is possibly why the schemes are not that much used for residential projects. The higher square feet rate for the commercial projects would leave some funds in the 30% free bracket for the builders to return as assured payments. The banning of unregulated deposit schemes Act 2019. The banning of unregulated deposit schemes Act 2019 came into effect on 21st Feb 2019. This act completely prohibits any and all sorts of unregulated deposit taking activity, which would include the amounts received in advance from the buyers. The banning of unregulated deposit schemes Act 2019 defines the term deposits as money received by way of an advance or loan or in any other form by any deposit taker with the promise to return, whether after a specified period or otherwise in cash or kind, with or without interest. However, the banning of unregulated deposit schemes Act 2019 also provides certain exceptions to such definition of deposit. Few of such exceptions are amounts received from scheduled banks or cooperative banks, public financial institutions notified by the central government, any amount whose repayment is guaranteed by the appropriate government or from a statutory authority, amount received from foreign governments, international banks, loans from relatives, etc. One of the exceptions to the definition of deposits is any credit by a buyer that a seller receives on sale of any movable property. Therefore, if the amount is collected from an allotee which meets these two requirements, namely is in connection with consideration of an immovable property and is adjusted against such immovable property, it would not fall within the definition of deposit as per the Act and would therefore not be considered to be a part of an unregulated deposit scheme. However, if any of the elements mentioned above is missing, it will fall within the definition of a deposit, and the banning of unregulated deposit schemes Act 2019 defines unregulated deposit scheme as a scheme or arrangement under which deposits are accepted by any deposit taker by way of business and which is not a regulated deposit scheme. The first schedule of the banning of unregulated deposit schemes Act 2019 provides for a list of regulated deposit schemes and arrangements, and anything that is not covered within this schedule would be an unregulated deposit scheme which is prohibited. Therefore, whether assured returns schemes are illegal or not depends upon whether the amounts taken from the allotee are covered within the definition of deposit or not, respectively. The Companies Act 2013, the companies while receiving deposits from the public have to strictly adhere to the provisions of the Companies Act 2013, Section 73 of the Companies Act 2013. It is important to understand if the money accepted under the schemes fall under the definition of deposit under the Companies Act 2013. Section 2, Clause 31 of the Act defines deposit to include any money received by the company by way of deposit or loan. It is a very wide and inclusive definition, so we need to look into the definition under the Company's Acceptance of Deposits Rules 2014. Rule 2C 12 of the said rules very clearly lay down that when an amount is received in the course or for purpose of the business, it shall not qualify as a deposit. The rule specifies that when the amount is received as a consideration for a property and shall be adjusted against such property, it shall not qualify as a deposit. Thus, there are no implications of the Companies Act 2013 on the arrangement of the assured return schemes. Reserve Bank of India. The Reserve Bank of India, RBI, is the regulator for the commercial banks in India with respect to subvention schemes. A notification dated September 3, 2013 was issued. According to the notifications, the banks need to link the disbursal of the loan amount to the various stages of the project. As a result of this notification, the banks cannot pay the whole loan amount to the builder upfront. The amount is released at various stages depending upon the stage of construction of the project. National Housing Bank. National Housing Bank NHB is the regulatory authority for the housing finance companies. In the lines of the above mentioned definition of the RBI, the NHB issued a notification on 19 July 2019. The notification is primarily about linking the disbursement of the loan amount with the construction stage of the project. It also directs the housing finance companies from entering into arrangements in the nature of subvention schemes. As a result of this notification, the housing finance companies and not the commercial banks cannot enter into subvention schemes. This notification has been of much debate in the real estate industry. The industry had been suffering from shortage of liquidity even before the COVID-induced lockdown happened, and such schemes were a source of finance for the builders. There is a lot of opposition to this notification. Possibly in future the government may introduce some changes. Thank you. Thanks for watching this video. Many thanks to you.